Welcome to the Stock Group. Today is Saturday, January 29th. And let's take a look at what the market did this past week. So we're going to look at the Dow Jones here. Dow Jones Industrial 30 stocks. You can see here this past week, the Dow was actually up for the week. Monday and Tuesday were up. Wednesday and Thursday was down. Then a pretty decent day on Friday. However, you can see that since January 13th, it's kind of been a down 5 or 6 straight days before it rebounded on Monday of this week. All right. The NASDAQ is a different picture. Going back to the 13th, you can see that, we're down many more days, but the fall actually started, back on the 4th of January. So we've really been just pretty much down this week, particularly up Monday and up Friday. But this fall was kind of hard here. Let's measure that out. Let's see. So NASDAQ tech related stocks. So anything tech probably was down. So you say we're down about 13% from the beginning of the year. I looked at our friend, the Russell. So it seems like the more charts we go through, the worse it get. So here, January 4th, you can see the Russell is continued to free fall. But let me give you a little bit more context on the Russell. The Russell has been in a free fall since November, had a little bounce in December, and then resumed this downtrend since the beginning of the year. So if you hold in any small stocks or small cap stocks, you've been taking a beating. Now for the traders, hopefully that you've been, you put stop losses in and you're not assuming all of these losses going down. If you are a long-term holder, you're in some pain right now. But if you're dollar cost averaging on a schedule, you should be picking up some, if you're monthly or you're bi-weekly, whatever the frequency is, you should be picking up things cheaper now. So, and let's look back at the S&P. So the S&P pretty much looks like, if we go back to January 4th, so you can see it's down as well. So most stocks in this last correction, since the beginning of the year, it's just been getting killed. Particularly, like I say, these small cap stocks. They've lost considerable value going back to November 8th. So let's look at a few names. But before I go, any questions on that? I'll pause there. And good morning to the other people that have joined. No questions? All right. So let's look at some of the names here. You know what? Let's go with some of the small caps first, because they've really taken a beating. So you can see here, it's APPS. It's a small cap stock. You can see since December 28th, it's pretty much just straight down. If you go back even further to like this November 2nd, down from 89 to 48. So it's almost half, rebounded to almost 70. And then now it's dropped back down to 37. So if you say from the 89 to the 40, it's more than 50% down. AQB, it's a $4 stock back in November. Now it's $1.50 stock. You look at the ARK, these are the Cathie Woods mutual funds. You can see that, since November, pretty much straight down, 50% loss in pretty much, let's see if it's true for all of these. Almost 50% here. About, yep, almost 50%. So pretty much most of these are down right at 40+% on all of these. So, and these are innovative stocks, tech related, higher PE stocks. And what I mean by PE is just what's called price earnings multiple. Just take the price of the stock divided by the earnings, and it comes up with a ratio. Those PE those stocks with high PEs, they've just been really getting killed lately. And sometimes some stocks, they don't even have a PE if they haven't made any earnings. So let's see a couple more. Scroll through the list, see some. All right, look at Chewy. Chewy is the e-commerce dog food. You see from November 5th, it's been cut more than half, from 80 down to 30s to, or about half. 43. CLSK is a Bitcoin related stock, from 22 to 6. So it's brutal on that one. See some of the others. EXPI, this is a virtual real estate company where they service brokers that don't have a physical office. You see here from 53 down to 24. So yeah, so these small cap stocks have really been taking a beating. This one that's getting killed as well. Fubo from 34 to 9, almost 10. So lost 60% of their value. So now, but you do have some, so again, those are high PE stocks. So anything with a high valuation, these stocks have really just been getting killed. Now, to contrast that with stocks that represent more value, or stocks that actually make money and have reasonable valuations. So you look at Apple. You know, Apple is down from the January 4th, which most everything is down from January 4th. But you can see it's not down that much. So hit a high 182 and it's at 170. Actually, earnings came out a couple days ago. So that's where you see this big green bar on Friday. So Apple did well. Now here's a bigger stock. What's the right word? It's a low PE stock, but they've got caught in this carnage. You can see from November here, 335 down to 239. So lost a, what is that measurement? Let's see how much that is. Lost about 28% down. So they got caught in the fray. But let's look at some of so a bit of the narrative is that inflation numbers came out, I think in December. They said inflation was at a 30-year high. Then the Fed started talking. So the Fed chairman, Jerome Powell, he had, been talking about they're going to try to basically rein in, the inflation. And to do so, they're proposing raising rates. And so as a result of that, raising interest rates, there's this relationship between rates and equities. And so as rates go up, there's more of a rotation to value, and sometimes they call it risk on, risk off. So when risk on, you're buying stocks and stocks are going up, you're not really caring so much for value. But risk off is you sell a lot of stocks and you move more toward fixed income assets, bonds, things of that nature, or even stocks that have more value, and you sell those kind of high flyers that have high PEs. And so I'm gonna just give you an example here of that. So look at Chewy. We're gonna look at Chewy's PE. So you can see here, I don't know if you're trying to highlight it. It's not highlighting. Let me draw. So you see where I'm drawing this square. If you just allow your eyes to go to the right here, it says price to earnings ratio. See my mouse here? Their PE ratio is 1,800, right? That's astronomical. And because of that, since their price to earning ratio is very, very highly valued, and as a result of that, well, I said it the wrong way. It's so high that it's not considered a value stock. It's really more speculative stock. And so because of this, the stock got hurt when there's talk of interest rates raising, or the market rotates out of the high flying stocks to more of the value. So if you compare that, say, with a Caterpillar, so you can see Caterpillar price earnings ratio is 17. So that's the difference between a high value stock. A speculative stock in Chewy versus more of a value play and something reasonably priced. So think of it a different way. Say if you're going shopping, you go to the mall, right? You say, okay, I'm gonna buy a dress, or you're gonna buy some shoes. So you can go either to say like I don't know, Cole Haan, or let's just say tennis shoes. So you go and buy some Skechers, which will be, lower value on a chain, or you can go to, Foot Locker and buy some Nikes or Adidas, and you're going to pay much more. So the Nike and Adidas, they will have a higher PE per se, because they cost more, but the value, it may not be a good value play. Whereas you can buy Skechers, you may be able to get two Skechers for the price of one pair of Nikes. And just to try to compare that analogy there, that's just the difference between some of the higher value, the higher valuation plays versus a lower value. So which one do you get a better use of your money? It's probably the easiest way to say it. So you get a better use of your money buying Skechers, because you're not having to spend as much, whereas you buy a high price pair of Nikes, you might be out of $200, whereas you may be able to get a pair of Skechers for $50, right? So there's a rotation out of the higher flyers and more toward value. So hopefully that analogy made sense. So let's look at
Mike, if you don't mind, can you repeat that again, please?
So I'm just trying to use an analogy of shopping. So if you were to buy some, let's say you take clothes, right? So you can go buy some jeans. You can either buy some Levi jeans, or you can buy some designer jeans, some name brand jeans like True Religion or something like that. Some of those premium jeans, what they call them, they may cost you $200, $300 a pair, where you may be able to buy a pair of Levi's, say for $50, $60, right? So they're both a pair of pants, and which one is the better value? Well, possibly the cheaper one. And that's just the, kind of the difference between high priced stocks that have a higher PE ratio versus stocks that have a lower PE. So let me show you another example. So if you compare, say, look at Apple, right? So you see Apple's PE ratio is 26.4, right? Whereas, let's look at APPS. Whereas APPS price ratio is 68. Now, the difference is APPS back in November, the stock was $91, right? Whereas now it's 40. So that PE ratio would have almost been double. So it would have been closer to 120 at that time. But even now, with the current PE ratio, it's at 68 versus an Apple. You can see that its PE ratio is 26. So this is 3 times, even though so here's the thing. You can always use PE ratios in order to evaluate stocks of different sizes. So it's a ratio that you compare 2 different things. So with that, this is 26, versus the Chewy, which was, the APPS, which was 68. So Apple was 3 times cheaper, even though the stock costs more, but it's 3 times cheaper from a price earnings ratio than APPS is. And so another way of saying that is Apple is a better value than APPS, even though it costs more, right? So that's a way that you compare companies of different sizes, and this kind of normalizes it to a single number to be able to determine what that is.
Got it.
Okay. So you look at a Boeing, right? A Boeing doesn't even have a price earnings ratio, and because of that, in order to have a PE ratio, you have the stock actually has to have positive earnings. If they have negative earnings, then you won't have a PE ratio, because the earnings is nothing more how much profit did you make, right? And so your profit is whatever cost your expenses are minus your revenues. If your revenues are higher than your expenses, then you have earnings, and then they can compute a PE ratio. But you can, if I look here, just click on this. So you see this little E down at the bottom. If I click here, you can see that the earnings revenue you can see that Boeing actually had negative earnings. So they didn't have earnings this time. And even though they had revenue, their expenses was higher than the revenue that they brought in. So that number was below 0. And because it was below 0, that's why they don't have a number here in their earnings. So it's so if you were to look at that, just like we showed that Chewy had a 1800, Chewy had positive earnings. And so they're even more value, just from a PE perspective than Boeing. But one thing about Boeing is their earnings have been negative because we've been in a pandemic, and, travel has been, pulled back significantly. So, but typically, Boeing if you look down here at the bottom, before the pandemic, this is a pandemic right here. Before the pandemic, Boeing had positive earnings, where it shows the green E versus you see these red E's to the right. So Boeing will be profitable again, but the last few quarters they have not been. Therefore, they don't have a PE.
Got it.
Okay. All right. So let's look at Facebook. Facebook changed their name to Meta. So if you see Meta, it's still Facebook. It's still the same ticker though, FB. So if you look at the PE ratio of Facebook is 21. So Facebook is even more of a value than Apple from a pure PE perspective, right? So again, that's how you can use that number to compare companies one toward another. So it's just been a huge rotation out of the higher PE stocks to the lower PE stocks. So, and a lot of your tech, particularly if they're smaller. So let's look at Robinhood as an example, right? So Robinhood doesn't even have, they haven't had earnings yet. So they've been losing money, right? So they don't even have a PE ratio. But you can see because of that.
Earnings, Mike.
Say it again.
They had earnings last week.
Oh, did they? Was it positive earnings? No, it's not positive earnings, right? They had earnings. They had an earnings report.
Yes, sir. That's what I should have said.
Okay, yeah. So yeah. Good point, Milton. So what happens is public companies, as a part of being public and they're traded on the markets, they have to report. So you can see here these 4 E's down at the bottom. So this is earnings that's yet to come in May, but they just had, as Milton said, they just had an earnings report. So they have to report this every quarter. And it's almost, think of your household, right? You have a budget. You have a budget even if you keep one or not, right? Because you got expenses and you got income. So every quarter, if you had to report what your budget is for your household, that will be the same as what these companies do on a quarterly basis, right? And a quarter is, first 3 months of every year, right? So you say, so the first quarter is January to March, second quarter, April to June, third, July to September, fourth, October to December, right? So those are the 4 quarters. And a company will report sometime within that quarter what their company's performance is. And it's accounting based on, like we talked about, earnings and revenue. So sales and earnings, same thing, tracking expenses and all of that. So they use a bunch of different ratios to determine. So if you look here, as Milton said, yes, they reported earnings on January 27th, Robinhood, that is. But you can see here, they were estimating that they were going to report minus 49%. That's what they reported, but they estimate 0.35. So they came in worse than what they wanted. But since all these numbers here at the top are negative, they have a negative earnings, where you can see they actually had sales revenue, but their expenses were higher than the amount of money that they brought in. Therefore, this number is negative. And then if you have a negative earnings, when you go to compute price ratio, you can't compute it with a negative earnings. Therefore, it's just a dash, right? And that's worse than having a very high PE. They don't even have a PE ratio, right? Again, because you have to have a positive number on your earnings to compute or PE earnings ratio. So, but you can see here that Robinhood has just been getting just killed, right? They IPO'd at 34, 33, and now the stock hit a low of 10. Yesterday was actually a good day. It was up pretty good yesterday. But if so, I know Christian used to have this stock. I don't know if he still has it or not, but I know he had it in this $40 area. Now it's worth a quarter of that. So this is an example where they just rotated out and just killed it. So now with us being in this bear market, it's brutal. So, but by the same token, there are some stocks out here that are performing well amidst of this. Now, pretty much everything got hit first of the year. It really doesn't matter. This is Lowe's, Lowe's, Home Depot, home improvement place. They're down a bit from their highs of 261. But, that's not, when you look at that compared to just that chart we looked at for Robinhood, they're only down 10%. Whereas if I go back to Robinhood and compute how far down they are from a percentage perspective, you go back to the highs, Robinhood is down 80 plus percent. So 10% down versus 80% down. So you know which one you would have liked to have been in. So that's just, so we're in a bear market. It's painful if you've held through some of this, but there are also some opportunities to buy some good companies. So that, I know I talked a lot about the PEs and the transition from higher valuated stocks to lower valuation stocks. What you can do is, so I actually put together a list because I was going through, because I have some stocks that have been getting killed as well. But one of the things I looked at and I said, well, let me put together a list of good companies, lower valuations, and to say, okay, if I'm going to start looking to buy some companies, I don't want to buy any of these those high flyers. I want to buy good companies with revenues that are not insanely valued. So you look here. So we said, so let's just go through these. So Apple, PE of 26, ADSK, which is Autodesk. So they make software for CAD drawings and modeling and all of that. So it's so you can see here market capitalization, $52 billion company. You see Apple is a $2.78 trillion, right? But still, ADSK is still a big company. AMT, cell phone towers, 40 PE ratio is 43. So its PE ratio is almost twice that of Apple, right? Amazon, PE ratio 54, so it's even higher, but still a good company with earnings, right? Costco, PE ratio of 41. CRM, which is Salesforce. Now, this is a much higher P ratio here, so I'll take that one out for that one because that was P ratio was 117. That's too much. Let's go to Gush. Gush is an ETF on oil. So also when you have this rotation out of the these higher flyer stocks, a lot of times there's a rotation toward commodities as well, like physical goods. So you think about oil, like grains. Sometimes grains are, do well. Copper. Trying to think another commodity that does well. So oil is one that typically does well. Energy usually does well. And so this is a ETF on oil services related companies. Home Depot 23, Lowe's 19, MasterCard. Now, if you look at the majority of these companies here, these are solid companies with name recognition, but they're big companies that actually produce good profits, and you can see their valuations are reasonable, right? So Microsoft was 31, MasterCard 40, Netflix 34, Nike 37, Nvidia 67, a little bit higher there. Qualcomm 20. That's actually cheap for Qualcomm. 20. Shopify 30. Team, which is I'll remove this one because they haven't even made earnings, so let me get that one out of there. Teams, UPS, 26. Visa 34. Then I have a VOO. This is a S&P 500 ETF, and then you got Google 24. So if you're looking to buy solid companies amidst this carnage that we've been going through with the market, these are some solid companies. And if you're fretting because everything you hold is down double digits percentage wise, you may want to start looking at these charts to see where they are in terms of support and resistance, and are they at some really low points or good buy points. Apple had a little pullback here to 55. Let's see. Autodesk. Now this is one that is pulled back sharply. Let me move these notes. So you can see here, it's pulled back pretty sharply from the high of 344. So whatever, and this is just my list, right, that I put together. I think it's decent in terms of for different value plays you're going to look at for some of these things that pull back off the highs. However, put you a list together, and if you're trying to go for, more solid companies, pay attention to these PE ratios. Now, what I don't have on this list, and we'll run through this. Let's look at some of the banks. So again, the narrative is the interest rates are going to increase. Jerome Powell came out this week. We were having a good day. I think that was either Tuesday. Was having a good day on Tuesday. He spoke at about 2:30 and just killed the market. I mean, market was doing well, up maybe a couple percent. About time he got finished speaking, the market was negative, big time. So they're talking about raising interest rates. So with that, what companies do well in a rising interest rates environment? Things that are based upon fixed income. So banks do well, financials. So let's look at Wells Fargo. You can see kind of from November, November timeframe, where the tech stocks started to roll over. You can see from November to December, particularly December 20th, the financials start really doing well, right? So that's in contrast to what some of the higher stocks were doing. So let's, since I'm here, let's look at this PE ratio on, so you can see this PE ratio of 10, right? That's Wells Fargo. Let's go to JP Morgan. All right. JP Morgan, PE ratio of 9.4. Goldman Sachs, let's see, P ratio of 5, right? So all these companies make more money in higher interest rate environments than they do. And so if rates will go up, as Jerome Powell has said, they're talking possibly 3 rate hikes, maybe this year, maybe 4. So as those interest rates go up, these financial stocks, they do well in a higher interest rates environment. So maybe another area to consider. So I'll stop there. Any comments?
One question is that is the PA ratio should be below 50 when you want to choose that? Is there any specific?
Yeah, I would say, anything 30s to 40s, or below. Yeah, is a good one. And you can see here, it as you can see the banks and the financial. So let's look at Prudential. So Prudential is an insurance company. Let's just compare them, because those banks, they were in the 10s or below, where you can see here, this PE ratio is 6. So the lower. Now you have to also look at, some of these companies. So let's look here. So they got earnings of 13 billion, 19 billion. Let's see what it was here. 14 billion. So 15 billion. So this earnings rate, they're growing their earnings, but their growth rates are typically not higher. And so when I were talking earlier about the valuation of the higher price stocks, growth typically have a higher valuation or higher PEs than value stocks. So a lot of times for growth is they're so more concerned about gaining new customer, winning new business, than they are with managing the expenses. So sometimes the expenses can get out of control. Therefore, the PE ratios are higher. Whereas these other companies, like these financials, they're not growth related companies. They'll have some growth, but they're not double-digit growth quarter over quarter type companies. And they're more stable companies, but their PEs are also lower as well. So that's the difference. And so again, yes, Kamal, I would say, anything under 40, but you can see here, you got some companies, particularly the financials. Again, where we are in the climate is that interest rates are going to go up, right? So you probably would do good if so one of the things is the market likes stability. It doesn't like uncertainty. The Fed has come out and they've talked pretty hard about raising interest rates, but they actually haven't done so. But just their talk has moved the markets down tremendously. But even though they actually haven't had an increase in rates, so they're guesstimating that the first rate hike may come sometime in March. But they've been talking about it as if they've done 2 rate hikes already. And so what the market is trying to do is price in, are they going to do a quarter point raise? Or are they going to do a 50%, a 50 basis point raise? So the market really doesn't know and is trying to figure it out. But in the meantime, there's just this huge rotation out of the growth stocks into the value stocks. And, these growth stocks have just been going down, double digit percentage losses. And so there's just a lot of volatility in the market as a result because of the uncertainty. So I think I wish they would raise rates sooner than later, at least get the first one out of the way. And then I think the markets can kind of figure out, how to adjust at that point. It won't be truly clear, because what happens is, just like I said, as the companies come out with earnings once a quarter, there's also economic data around the economy that comes out monthly and quarterly as well. So the Fed looks at that data, like the GDP, employment, consumer sentiment, not interest rates, but inflation. They look at a bunch of that different data to try to determine the health of the economy, because where we have been. So if I go back, let me look here. So if I go back to the, just use the S&P, right? Use SPY. Let's see let me kill all these drawings, right? I want to show you something. Okay. So this is S&P 500, right? So let me just put one line on here. Okay. So this bottom peak here is the pandemic low, right? But I want to show you something. We're going to go even farther back than that. So I'm going to have to go to a weekly for this. All right, I'm going to draw another line here. Then give two circles. All right, see that circle there? And then this circle here. All right. So what this chart is S&P 500. You can just use it as opposed to looking at the other three indexes. You can use S&P 500 to kind of be a barometer for the whole market in general, right? So this is going back to 2009. What happened in 2008, 2009? Anybody? 2008, 2009. What happened?
The financial crisis.
Thank you. Financial crisis, right? So coming off of these lows of 2009, right? We have been, so from 2009 up until 2020, we were in an interest rate environment where the Fed was cutting rates and buying bonds. And you may have heard this term called quantitative easing, right? Basically, they're putting money into the market. So we've been a quantitative easing environment really for the last, we're 2022 now. So that's what, 11 years, 12 years. So last 10, 11 years that we've been in that environment. As a result of that, money is cheaper to borrow. When money is cheaper to borrow, people take bets with the money and they'll put it to where the assets are growing. The stock market was growing since 2009. We really didn't have a pullback, a significant pullback, until we got to the Corona, March of 2020. And then off of the March of 2020 lows, where you can see this. So let's draw where you can see here. So the market was up 317% off of the financial crisis lows. Then from the pandemic lows, you can even see higher. Let's see. So from pandemic, so that was 317. So the pandemic lows to the high was another 100 123%, right? So you say so if you take this from high to low, from 2009 to the highs of 2021, that's 802%, right? And this was all happening in a interest rate environment that was either going negative interest rates, really where interest rates were very, very low. So this, but with the Fed now changing their tune to say that they're going to start raising rates, so I don't know how true this is, but one of the things that I've heard was that the Fed was also buying a bunch of equities, meaning buying stocks in the stock market. And so the thesis was, if they're buying stocks in this market, then a lot of these stocks are overvaluated, or they're overpriced. And with them being overpriced, then the idea was, if the Fed stopped buying, then these assets are just inflated, and they're going to start to pull the value out of those assets when they start selling. You know, I don't know if that was the case or not, but I know the talk of the speculation of, the talk of interest rates, that has caused people to start selling those higher evaluated stocks and buying lower, or just going to the sideline. So you can see here, we're in terms of how much percentage down. So we're about 11% down on the S&P. And to get into so 10% is called a correction, technically. 20% down off the highs is called a bear market. So we're not that far from getting to a bear market if we get to the S&P at 381 or 3,800, just depending upon which one you're looking at. So, but
can you say that again? About what the 10% and the others? Can you say that again? Yeah.
So they say that a 10% pullback in the market is referred to as a correction. A 20% more pullback in the market is considered a bear market.
Okay.
So we're just in a correction right now, but headed to a bear market if we don't stabilize. So, yes, ma'am. I'll pause there. I know it's probably a lot, but I'm just trying to give you, the information so you can kind of get a sense of what's going on at a higher level. Because the individual stocks that you hold and own, or even maybe consider buying, this news and this narrative affects those prices. So, any other questions? Any comments? Milt, I know you've been dealing with the markets for a long time. You got any commentary on any of that?
Well, one, I'm going to agree with everything you said wholeheartedly, because this is about as true as you can get about the market. One comment I have, there seem to be two types of people. Well, there's always more, but two types of streams when it comes to the market. When it's doing well, like it has been, you have people who think they are the band leader, and they jump in front, and they think they are leading the band. The Fed always leads the band. When the Fed tells you to take risk off, if you want to keep your money, you take risk off. Which I think it was the last November meeting we had, we talked about that. You cannot own high PE or stocks that lose money. And you have shown exactly why you cannot do that. Now, saying all that, when you see a market going down like this is the perfect time for stocks that you are going to own long term. Long term. Like my long term is 5 years and beyond. Like the VU that you have, I will probably die owning that. So this is where you make your real money. When you see a market like this, it already told you it's stable right now. So this is the time for you to start doing a dollar cost average into the market and the things that you're gonna have for a long, long time. Now, is this the final leg? I don't really think so, but I don't know. I'm not gonna tell you I'm a band leader. I am not. I see where the band going, I follow behind it. Right now, it's telling me it's stable, but it could drop off a cliff so easily again because everybody's so afraid of what the Fed is doing. And Mike, what you said about the Fed buy equity, no, they don't ever do that. But I have seen money come to this market that is not an individual and is not aiding these big money makers. It has to be a government entity to be able to pour that much money in there. The first time I saw it was in 2008 when I was watching Goldman Sachs. They were doing a raid on Goldman Sachs, which means they were forcing the stock down. And that's how you force companies into bankruptcy and you break a company. And all of a sudden it just stopped like it hit a cement wall. Only big money can stop something like that. When all the, the little small money managers try to take something down, only the government can stop that. So right now, if you know the government have equity on their books, quote unquote, they're not gonna just dump it and destroy the market, but they will get it out their book. That's one. Number two, one thing we know is that they have bought bonds of all these companies. I'm pretty sure they own what is the airliner, aircraft maker you were talking about, Mike?
Boeing.
Yeah, Boeing. I 100% know they bought Boeing bonds. They pretty much said they did. They were buying company bonds. Now, if you have to go to the capital market now when the Fed does not have your back, all of a sudden you will have to pay a horrendous interest rate, and you're going to destroy your capital, which is your stock. So that's 100% why people are just getting rid of things that lose money. Now, saying that, dollar cost average, like take Boeing for instance. I don't particularly like them. There's a reason for they killed 2 plane loads of people, Mike. That's why I don't like them.
Yes, sir.
But in the old days, I would be dollar cost averaging in the Boeing. And the reason why is these new trading apps and everything, I could put $5 a week into Boeing. So, it's sort of like it helps the individual investor dollar cost average into good company. I can tell you right now, what I would buy is some Apple and some Microsoft. Their earnings were killer. And when people are washed with money, they're gonna buy, well, first, Microsoft, businesses, I don't care what. We don't wanna buy Microsoft. We know we're getting ripped off, but we throw our money at them as a business and move on. Because we got to have them. There is no substitute for Windows and Office. These other ancillary products you see, if you're a real business and you got those, there's something wrong with you and you will pay a price for that. And most businesses know that. So Microsoft, definitely, after their earnings, yeah, I want some more of that. But I'm not going all in anything. My investing has just been slaughtered because these are, this is the time people are fearful too. So they just throw everything out. They don't care if it's making money or not. They just throw it out. That's why you see so many charts going down. But last week, just before Powell spoke, you saw the market said, this is it. This is when all those little individual investors, and actually major investors too, said, I don't want to own stock, and they threw their hands up. That's what makes a bottom. When that market dropped big and then went green, that was a telling sign that this is time for a trader to come in and make some money. My trading account is very good this year. I've had really 4 trades, and 3 of them have been quite successful. Not as much as I usually do. Successful to me now means 3-4%. Before, it would be more like 10-15. And my losses, I do not take losses lightly. If something's going against me, I won't even let it go past about 5%. It's gone. Don't care about afterwards. I know I cannot lose money in a market like this. It's so vicious. It can just destroy your capital as a trader. So you have to make quick trades, and you have to not be afraid. The market, like I said, follow the band. When that market went deep in the red like that and turned green, I tell you, you need to find a good trade.
Yes, sir. Thanks for that, Milt. I definitely agree. And so in his commentary there, he made a big distinction between if you're an investor or if you're a trader, right? And so investors, so this is my investing, list here. So if I'm going to be looking to invest, these are some companies that I would look at, and a couple ETFs are put in there as well. But if you're trading, he's right. You gotta look for a setup, get in and get out, because if not, this market, so let me just show what happened. I think it was Tuesday. And was it Tuesday? Let's see, Friday, Thursday, Wednesday. I think it's a down day. I think it was actually this day here. 15-minute chart. That would have been right here. I'm trying to see what day was that. I think this is it here. Let's see. And I can't find the chart, but it was earlier this week. The market was up good. Like I say, Powell came on at 2:15 and just killed the market. I mean, the market was flying, but it was just a 1-day move, and everything turned around, and from there it was just continued to go down from there. So, but again, that would have been considered a trade. Whereas when I showed this SPY, let me go back to this SPY here on that weekly. Think of it like this. When Milt talked about that VOO, the VOO is nothing but this S&P chart, right? It's just an ETF for the S&P. So that was 800+% over 11-year period, right? So 8 times your money over 11 years. So, probably, I don't know what that is annually, but it's a good percentage nonetheless. But these pullbacks here are significant. And if we can absorb whatever this pullback is going to end up being, if it's going to stay in this 10% variety, or if it's going to go lower to the 20%, or something even lower than that, right? I don't know, but we'll have to see where this shakes out. And so hopefully we'll have a bit more clarity, probably by June. We should have at least a rate increase or 2 to kind of see what the inflation, what the Fed and all of that is going to do, to see what they're doing about risk assets. But right now they're selling these growth. They're moving more toward value. And but just because you have your list together. So let's take Microsoft here, right? You can see here, even since what is that? Let me go back to a daily. So you can see here, hit a high back in November, hit another high here in December 19th. 29th. But since December 29th, we've still been in a downturn, even on Apple, even though it's a good stock. So well, how much is that percentage down? So from there, we were down at the lowest, 19% down, but then we got a rebound. So to where we are today. So you're still down 10% on Apple, right? So they can still even bring some of the best of the breed down as well if this market continues lower. But if you take the long-term view, just dollar cost average in, you know, and because you're buying good companies, and when you dollar cost average in, it's just going to get you the best price over a long term, such that you don't have to guess at any one point to try to figure out what the bottom is. Okay. Let's see. So that's pretty much what I have for now. Any other questions? Yes, no, maybe.
Nothing from me.
What's up, Dick? What's up, Barry? Y'all got any comments, questions?
Nah, Mike. Good job.
All right. Thanks, Barry. All right. Ella must be on a call. All right. Well, cool, guys. Hopefully that was helpful. Again, look at, you know, if you're going to be adding to your portfolio, put your list together. Dollar cost average, you know, kind of like Milt said, you know, see what the market is doing and then adjust as opposed to trying to anticipate. For the long-term holders out there, take that 5-year or longer approach, add good companies to it, and you know, dollar cost average in. Traders, be careful. That's all I can say. Be careful, and if you get profits, take them, because they may not last long.
Hey, Mike, I just want to thank you for your dedication. I know I don't get on here every Saturday, but every time I get on, I have I get a lot of knowledge from you. So thank you.
Oh no, thank you. It's collaborative. I appreciate everybody. You know, it's and I thank you all for joining too, when you can, because, you know, my whole goal in this was I wanted, you know, people just to become much more aware of this stuff and how it works, you know, and so the education is one point, but the execution is a whole nother thing, right? But yeah, so, you know, but it only works when we have the education and the participation, you know, because a lot of people say they want to change, you know, areas of their life, become, you know, learn about a particular subject, but, you know, many times they don't put in the time to do so. So it's more of a wish and a thought than actually, you know, some dedication behind it. So I appreciate you all for showing up every week, and I know your work schedules are varied, but thanks for getting on when you can and participating, because I learned a lot from you all, you know, as well. You make me have to go and research stuff and figure out some things that if I was just doing this by myself in a vacuum, you know, I wouldn't learn as much as well. So it goes both ways. So thank you as well. So I don't have anything else. If there's some particular names or other general financial questions that we need to talk about, we can. So the floor is open.
I wanted to talk really quick about earnings.
Okay.
Right now, if this market is stable, and I say if, because I'm still thinking that we're going to be going down some more, but I think we have a tradable bottom right now. I think.
Okay.
By that, I mean anything I invest in, I'm ready to pull the trigger to get out as soon as I buy it. But
Okay.
right now, Microsoft and Apple are telling me they want my money.
Yeah, I think Microsoft and Apple both they did well. Definitely both did well off of earnings. Google comes up on the 1st of February. It's gonna be interesting to see what they do as well.
Hey, Milton, what do you think about Amazon?
There's an issue with Amazon right now. Long term, I would be buying Amazon, but right now I'm a little don't want to touch them. That could change. Mike, do you know when their earnings are? I haven't really followed them.
Yes, it says here on February 3rd.
Yeah, take a look at that. There's a reason it's like this. They have a lot of expenses from the pandemic. It's just, things that they have to do inside because they will get sued. And I think they already have at least once because of, I think, excuse me. I think what's going through right now is making a lot of people mix work. So that's also adding extra cost to them. Plus all these features that they have to put in for the safety of their workers is costing them a lot of money. So right now, I like them long term, but right now, the trader and me don't want to touch them.
Well, let me ask you, Milton, do you own any of this in your long-term portfolio?
In my long-term portfolio, I have just the standard things, boo-like things in there.
Okay.
The only stock I have is some Wells Fargo preferred.
Okay. What's the preferred on the Wells Fargo? What's the
You're not going to be looking that baby up. It's so hard to find.
Let's see. Is it the peak? Is it here? PQ?
It's 1,000 and something, whatever it is. It is hard to find on there. That's why I never look it up on the stock chart. It's just so hard to find that one.
Okay, gotcha.
But I think it's 1,400 right now.
All right. Let's see if I can spell preferred right.
And that's one of those things that tell you opportunity. I mean, when it's the darkest day, that's when you should be looking for some opportunity. Because that fell to my lap. I think I get 18% a year interest on this. My only regret is that was when I was a baby investor. I didn't have a lot of money.
Okay. Trying to see. Yeah, I don't know what because typically they'll say preferred here in it.
I mean, it is truly hard to find on the stock chart. The symbol is so weird. I don't think you can even see the symbol.
Okay.
But hold on, give me 1 second. Let me take a quick look and see. I can tell you what E-Trade calls it, but
Yeah,
I'm not sure you'll be able to find that. Okay, it's WFC.PR.L.
PR dot what?
L.
Oh, okay. PR. There we go. Yeah. Here we go. Is it right here? Let's chart this up real quick. Resistance. Okay. Yeah, so definitely come up to some support here at this 1390. After this pullback off of this 1498, and they, what is it, 7.5% yield on this?
That's what it is now,
Okay.
because it has gone up a lot. But
Okay.
yeah, that's still a pretty good interest rate.
Yeah.
I mean, dollar cost averaging is more.
Okay.
You know, it's sort of weird. I never thought to add more money to that. Okay, I got mental problems now to see.
It's all right.
See,
Hey,
that's why I love to come here, Mike, because it, just something else just always pop up. And now I just realized I have never put any more money into this thing.
Right. So you see this trend here is definitely riding that trend on up for sure. And it just broke it. If I continue that, it just broke it on this last pullback. And then you got this little box that it was in from 15 to 445. Yeah. So definitely interesting. Okay. That's one thing I've never really played preferred shares before. So yeah. But yeah, so what is this percentage wise off the pandemic lows? 64%. Okay. Got it. Cool. Barry, are you buying, you adding anything to your portfolio here lately?
No.
Okay. Let's look at this.
I'm trying to just wait, see what's gonna happen a little bit. I need a couple more win days before I put some money in there. See where it's heading to. Because 4 weeks of loss, we don't know about that.
Yeah, but
That's a good strategy to me too.
yeah,
Huh?
yeah. Being on the sidelines is a good strategy in this market for sure. I wish I'd have went to the sidelines. I didn't, and I'm suffering as a result of it. But I'm not panicking neither. There was a couple days last week. I looked at my portfolio. I was like, "What is wrong with you, man?" And it was just brutal. However, one thing I did do, and it was kind of actually to Milt's point, I actually bought some Apple yesterday in the aftermarket because I put this list together. So I was going through. So when you start to experience some of these losses and it tests your resolve, I started to say, okay, well, what do I need to do? And I kind of came up with this list here saying, okay, if I'm going to add, these are some of the things I need to add to, because I've added to some of the other higher flyer stocks because I just thought that, that they're a value, that they're going to turn around. But I didn't add to some of the better core stocks here. So I put this list together to say, okay, if I'm going to add, let me add to some good companies. Because I actually missed out on, but two, actually, we talked about this for a few weeks. And I talked about it, but I didn't actually squeeze the trigger. Was in this downturn here, we saw this, and actually let me move it over so I'll show you what was happening kind of real time. So I saw this pullback here, and all of this stuff was going, and it was actually happening in tandem with like PayPal, Square. So Visa, MasterCard, PayPal, and Square were all kind of tracking together. So, and they were down here. So if you look at this percentage, so I saw this and I didn't. So they were down 17%. And I actually talked about this several weeks, and I didn't buy any of this MasterCard here. If you look at this Visa, it was pretty similar, right? But so that was it. You can see here, I even marked it with this circle. But look at what happened since, right? So we're talking from this low of December 3rd, November 30th, December 3rd, That's a 19% gain in 2 months, 3 months that I saw, but I didn't take advantage of. So one of the things is that I got to execute, better. And there was a divergence with the Visa, the MasterCard. But if you look at the PayPal and the Square, they've just continued down since. So that was like December 3rd. So you can see December 3rd, they kind of went up to December 8th, went sideways, and then the bottom fell out in January. Square, again, these are payment companies. They've just been decimated all the way down, right? Now, I think Square is going to be better long term. But here's the difference here. You got this PE ratio of 100 here on Square, whereas if you go back to Visa, it's a 34. You go to MasterCard, it's a 40, right? So that's the difference, even though all three of those are in the payment arena, whereas they value Visa and MasterCard at a much more reasonable valuation versus Square was this high value, high valuation, and they're getting killed, So you can see how the stocks have just taken different perspectives, and that's because it's just this growth. You're getting punished for this growth number here because it just costs too much, because it's just better value with Visa and MasterCard, even though they're all in the same, type of space.
You look at American Express too.
Yeah. Yep. So you see here, that's that December low, but actually they got hit again right here, right before earnings, down to this 152. But they're back up 177. So if you measure this out from this secondary, this is just most recent low, up 16%. And that's literally, this is 1, 2, 3, 4, up 5 days, 16% in 5 days. That's crazy. Whereas off of that low, you're talking 18%, right? So that's a year. This is done in a year's. Matter of fact, this must have been 1, 2, 3. Was this Monday? He was Monday or Tuesday with that crazy Powell news. And then they had great earnings on top of it. So both of those together gave you a 16% move in literally 5 days. So I just start to put this list together here to figure out, hey, where do I need to add to in terms of the long-term thing. And so as I was going through this yesterday, I asked myself, it's like, and this is kind of what made me buy Apple. And every time I sell Apple, I even remember saying this to my friend last year. I said, every time I sell Apple, I end up regretting it. And I remember Apple at 118. I know where it was specifically. Mm-hmm. I can go back to this chart, right? I just know what that number was, right? And I didn't buy here.
Yeah.
And I knew it. And every time I sell Apple, I regret it. And I shouldn't have. So just getting because there's a difference between the education and the execution, right? You can know the information, but you got to put the information to work. And so just like I saw here, I had the information on Visa, but I didn't squeeze the trigger here, right? I had the information on MasterCard, didn't squeeze the trigger there, right? So I was like, hey, I got some of the Apple yesterday. I'm just going to add more to the position. I have a number of that I'm trying to get to. So I added a quarter of it yesterday, and I'm going to add some more as time goes on. I like Apple. Actually, this Costco bounced off this 469. I like Costco. It's reasonable PE on it. If you look at this chart, I mean, Costco has just been, if you look off these pandemic lows, you know, from 309 to 570. What is that?
Costco actually look nice.
Yeah. So you're talking 85% up move and got a pull back here of 16%. So yeah. So like Costco is one that I sold. I kicked myself on this. I was right about this trade. I just didn't hold it long enough. It was this Home Depot. I remember the Home Depot in this, this is even pre-pandemic, like this 170, I want to say 130 area. But Home Depot went crazy. And you know, well, so Barry, you own any Home Depot or Lowe's?
No, I was doing the VU. I pulled when I lost about 5%. I think I bought it at 400 at the highs. And then when I saw this sucker going down to 35, 435, 420, I was like, oh no.
Yeah, but here's the thing though. So, and the reason why I asked you about Home Depot and Lowe's specifically is, and this is where using what you know to your advantage. You're in a real estate game, right? You know that game. You play it specifically. But sometimes you just got to take that extra step and say, okay, when you know that, it's almost like it's so close to you that you don't see it, right? Whereas if you go back here, and this is the thing that we all can say, we know that these housing prices have been going crazy over the last, you know, particularly off of these Corona lows, right? Pandemic lows. Why we all don't have no Home Depot? You know what I mean? So it's, you know, so that's one of the things where, and maybe I'll include a segment and y'all remind me, and maybe we just call it, you know, what do you know? And because sometimes, so I'll give you, so we can say, yeah, we can't really cry over spilled milk. We missed that, right? But we can say now, and Milt has talked about this, and that is, what do we know? We know that inflation is at an all-time high. We know that the Fed is going to raise rates. So since we know those things, what should we do based upon what we know? We should be in financials. We should have some exposure to financials, right?
Yeah. And we know there's a housing shortage, so they got a bill, you know?
Okay. And you know, so given that, then does Home Depot and Lowe's on this pullback, does it make sense to add some more given that fact? So I remember this back in 2000. Let me pull this back. Shucks, I had to go to weekly for it. I never forget this. So back in 2003, so from like 2003 to I don't know what the housing index. There's a ETF for housing. Let me see if I can find it. But anyway, so from 2003 to I thought the market was overvalued 2003 from a housing perspective, right? And that thing ran, and I was like, man, this can't keep running, because I remember talking to one of my buddies, and it probably went 5 years past, or 6 years. So you say 2003, and it didn't burst until 2008, right? So if you say where we are in the same cycle, that these housing prices, they can't keep going where they are. But so we're in 22 now. Will it be 26, 27 before we get a housing correction? But if, let's say that's the case, say the housing market doesn't crash until 27, 28, right? If it does, you know, are there much more gains to make, say in a Home Depot or Lowe's or something that's housing related for the next 4 years? You see what I mean? So it's like taking that information that you know and putting it to work, and not just where it's, oh, that's a fun fact, but you're actually putting that fact, you know, to work for you based upon what you're buying. So, you know, so that's one of the things. So I know the interest rate thing, you know, Milt has told us I know I missed some of this move off of these November and December moves, particularly, that's a date, that's a week. Let me go back to this. Yeah, so these December 20th, December 3rd, depending upon which chart you look at, missed some of that uptrend there. You know, take pretty much any of these banks. They all were actually. Now this is interesting. Milt, what's up with this JP Morgan? Because they really not following suit to some of this other stuff. It kind of got killed here.
Okay, that was easy enough. The earnings suck. Let's start with that.
Okay.
And our banks are not going up. The banks that are more sensitive to interest rates. Those are the ones that are going to go up. So those are, when you said financials, our financials are not good. Some of them interest rate actually hurt.
Okay.
And that's because they're too invested in businesses. And businesses have a hard time paying loans back when the interest on those loans go up. Now, there are others that are more interest sensitive. So it's sort of like as the interest rate goes up, they're paying people dirt. It's well, you know, in your savings account. So that spread of dirt, which they are not going to ever increase. Why should they?
Mm-hmm.
But their top line of what they charge does go up. So they make a killing. That's Bank of America. Bank of America. Let's see, what's another one? Wells Fargo. How could I forget them? I think Citi is one of them too. And then some of the smaller banks like the rich small banks. Signet. I forgot the name of it. But it's one of the small ones that I follow because I remember when banks had their runs and I saw banks double.
Mm-hmm.
I'm not sure we into that because I don't think the Fed's going to raise interest rates that high. People are talking about they're going to raise. I've heard everything up to 6 times. Mm-hmm. And if they're doing a quarter, 6 times, that's still a very low interest rate.
Yeah, 1.5, right.
So the part that people are panicking is they are stop buying stuff. That's what hurts. The interest rate, though, that little interest rate is not going to do much. The stop buying and start selling, that is what's going to hurt.
Okay. So of your top, you would say Citi, Wells, and Bank of America.
And let's throw in Morgan Stanley, MS. They had a good earnings too. I mean, it's really simple. When they have earnings, see what the market thinks. If the market hates their earning, you hate the stock.
Okay. All right. That sounds simple enough. Yeah. So, given that, so just trying to these banks that loan out. So, we take those top 3. Wells. Let me put a little list together here.
Milton, you ain't going with Goldman Sachs?
Pull up, if you could you pull them up really quick and take a look at when they had earnings.
They didn't pass the earnings test. They got killed.
Now saying all that, they still Goldman Sachs, but right now, we're not friends.
Okay. Yeah. So if you look here, right here. Yeah. So they're right here at some, so close to support. Well, they were at this 320, but it got a bounce this week. Actually, this week was actually pretty decent for them. So.
Yeah, could you pull back pull in on that a little? Okay. Yeah, I'm glad you brought that because that's one of those. Now, here's the deal. You know that they've been slaughtered. You know other banks are doing better. But this is like it's making a nice little pretty basing pattern down there. It's not one of my favorite.
320. Yeah.
But if you like Apple, you might want to get Goldman Sachs because they run the Apple Card.
I agree with you on that because the more Apple sells, the more services go through and the more money they make on that.
I'll give you a better one. It's not that one.
Oh, it's not.
There is no. It's So like when you buy, what is it? I got it too. Just gotta find it.
Mm.
So when you buy a phone and you do the, let me see. I just gotta find out what the name of it is. It begins. Hold on, let me look it up on my phone. I'll find it. But y'all can go ahead. I'll tell you what it is in a second.
But I know Goldman Sachs, don't they run the Apple Pay?
They
Well,
do
Well, go ahead, Mel. Go ahead.
that, and another thing is another reason to be careful with Square, by the way. Apple may be going into that contactless payment thing. You know where you have that little Square card that businesses use for payments? I think Apple may be muscling in on that, and that will help Goldman Sachs too.
Mm-hmm.
I'm trying to find.
Right. That could be a very good call. I'm going to have to take a quick look at those guys.
I'm trying to find, because I had bought a iPhone a few years back, and the company, I'm trying to find the company that serviced the payment plan. It was a bank that did the payments, and I remember looking them up.
Oh, I think I know, cause I used to Citizen. Is it something like that?
Say it again.
Was it Citizen?
Yeah, it's something. Yeah, something like that. It is. It might be Citizens Bank Corp or something, I think. Let me see. I got it. I just trying to find an old thing in my phone. You know what? I think I know where I can go. I think I put it in my old tax stuff. Let me see.
One thing I got to tell you, you have to be very careful with that one right now. And the reason why is because these phone companies are throwing phones at people. So they're probably not going to go through them. In other words, if you go to Verizon, they want to give you a phone or give you something else to get one of their plans.
Mm-hmm.
So that may be a reduction in things going to whatever that company you're talking about. So that one that you definitely want to chart up before you go into.
Yeah, I'm trying to. I just can't put the right subject in here because I'm doing iPhone payment. It's not coming up in my email. It was you know what? Do this. So it was a bank. Let's see. Y'all keep going. I'm just trying to find this in my email. Let me see. Was it Citizens? I hate when I can't find something. Let's see. Probably can Google it and find it quicker. Let's see. Yeah, Citizens won. That's it. I knew it was a bank. Yep, that's it. Citizens won. Bank was a ticker CFG. I had this. So I must have took it out. yeah, so I bought this, and this is one I bought that phone. Be 3 years, 20. So I bought it in 19, right? So bought it in like August of 19. So it's at 33 here. And I remember looking at this. So, but yeah, this is a company that does their payment plans for the phones. So even off of these pandemic lows, you can see it's just been up to the right on this. So got a little pullback here this, last week, but still, it's just I'm putting this in my watch list. Won't lose it again. Okay. But yeah, so that that whole idea around what we know and taking that information and then making it actionable. So. Because I think a lot of times we go over stuff, or we may have these ideas but don't follow up on them, and be right about the thesis but don't put any money behind it on that thesis, only to see that you're right but you didn't benefit from being right. So